Good afternoon, ladies and gentlemen, and welcome to the first of what we hope will be many webinars hosted by Mining Review Africa. My name is Claire Falkbane. I'm standing in for Laura Cornish, who is currently traveling. Now, it gives me great pleasure today to introduce Peter Major, Director of Mining for Cadiz Corporate Solutions. Peter has been working in the mining industry in Africa since 1982. And joined Cadiz in 2006, where he is Director, Mining, focusing on private equity, capital raising, and merger and acquisition activity in the mining and resources sector. The topic of our webinar today focuses on Zambia, the DRC, and South Africa, and compares them to the regulatory and investment policies in Chile. Zambia, the DRC, and South Africa are countries with a strong dependence on mining and minerals, each with a very different history, investment policies, and focuses. Yet, while Zambia and the DRC are seen as viable if somewhat risky investment opportunities, South Africa is increasingly seen as a high-risk environment in which investors are losing faith. Recently, the Chamber of Mines in Zambia highlighted that country is lagging behind Chile in mining productivity, despite having started at the same level in the 1970s. Today, Chile produces 8 times as much copper as Zambia, has a larger economy, a lower poverty rate, and a higher overall standard of living for its citizens. Given the similarity between the two countries, Chile holds valuable lessons as Zambia seeks to attract investment, boost copper production, and ensure that all citizens benefit from the wealth generated from that copper. Peter, without any further ado, I hand over to you.
Thank you, Claire, and thank you, ladies and gentlemen, for joining us. If you're in sunny South Africa, I can say good afternoon, but if you're scattered all over the world, it could be midnight, 4 a.m., 12 noon. So welcome wherever you're at. I hope you're awake enough to see the graphs we've got here. I'm going to give you more of an overview than a specific checklist. I know people like putting scorecards together and analyzing the numbers and saying, oh, this is what South Africa needs to do, or this is what Zambia needs to do. So what I'm going to do in my presentation, it's a lot of overview slides, looking from the top down and concentrating on the results. And there's lots of evidence in my slides what could cause these results. But I think once you grasp how different the results are and the trends, then it's easier to pick out what elements have caused that and what changes would we need to make if we want changes in our declining trends, if we want positive changes in our metal production, in our gross wealth per capita. So I'm not going to talk too much. I'm going to let the slides do the talking. The ones that have a lot of verbiage on, I may even go over quickly, but it's the pictures that are really going to give us an idea of the big differences in these 4 large mining countries. Real quickly, there's a disclaimer there. It means if you're unhappy with what I've presented, it's going to be hard for you to sue Cadiz. Might be easier to sue me, but I'm worth much less. So I'd rather you just complain to me and we can discuss it like adults. Africa, this can be argued, but it has close to half the world's known minerals. I say no one mining them, but there's not nearly enough people mining the minerals we've got. And in South Africa alone, we're sitting on 6,150 abandoned mines. We were sitting on these abandoned mines the last 15 years during the greatest commodity boom the world ever saw. South Africa led the world in gold production for 100 years. That's a long record. Chile now looks set to do the same thing in copper. Now, how do you lead the world for 100 years? Obviously, you need a good ore body, because no one is going to spend big money if you don't have a great ore body. You need stable governments. Money's not going to flow if your government's unstable. Hot money will, small, fast money, but not the real big money long term. Stable legislation. Not just stable governments, but you need legislation that doesn't change all the time. Again, we need long-term confidence to spend this money. Mining is big money. It is long-term. It needs decades of investment, stability, and work to get out the kind of return that will encourage people to come in. And how do you get this? You get it with symbiosis and innovation. Symbiosis means government, industry, and workers are all rowing in the same direction, not fighting each other and going in different directions. Where are you on the curve? That's a good place to start. Rule number one in life, whatever you're going to decide, know where you're starting from. South Africa alone is 3.5 times larger than Japan, Germany, 5 times bigger than the UK, 12 times larger than Korea. And why do I pick these 4 countries? Various reasons. They're very successfully, from a capitalist point of view, from a living standard point of view, and they have very few minerals. So you can ask yourself, why isn't South Africa, Zambia, and the DRC anywhere close to these countries when we have many more minerals? Our GDP, 8 times less than the rest of the world. And it's probably barely half of Chile's. And yet here's South Africa mining 70% of the world's gold, platinum, and many other minerals for decades. Zambia and the DRC together, and Zambia even alone, was mining more copper than Chile in the 70s, late 60s, early 70s. So how did Chile surpass these 2 African copper titans? It seemed to really change around 1980, and we'll try and see why, who's responsible. But for one thing, just South Africa alone, the Chamber of Mines quotes 2,000 pieces of mining legislation since 1995, over 3,000 policy changes since 1994. These are massive amounts of paperwork and laws. How many people can even follow the 10 Commandments that we've had for 2,000, 3,000 years? Now, if you battle to follow the 10 Commandments, 3,000 years. Now, if you battle, where are you on the curve, part 2? Let's look where we are today. South Africa, 56 million people. The DRC, 71 million. Zambia and Chile almost tied. But go back to 1960. South Africa had 18 million people. DRC 16, Zambia 3. And it's important to look at this because population has an effect. When you've got a rapidly growing population, you have rapidly growing demands. And most governments are populist by nature. So they often will cave into demands, populist-type demands, instead of doing what's right that will make good, medium, and long-term sense. Chile's done a very good job of controlling its population in 50 years. It hasn't hardly doubled it. They've done a very good job of educating their people in all respects, educating them in respect of industry, how your country earns money. And that's very important. Instead of demonizing industry, they've educated their people to respect industry. So since 1980, Chile's had a very predictable, realistic mining code. Its government and workers have appreciated this, and they've helped mining. Where are you on the curve, and where were you? Well, look where South Africa was. For 100 years, we were the dominant gold producer, and it all changed in around 1981. That's when the gold price in real terms peaked. And why did it change then? Various reasons. The population and the workers in this country were able to make demands and to get those demands satisfied. And that took precedence over keeping our production growing. Whereas the rest of the world, at the prices we saw from 1980, 81 onwards, the rest of the world said, gee, this is so much better than $35 an ounce. We can definitely produce gold and make money. So while South Africa spent more time addressing so-called legacy issues, the rest of the world spent their time looking forward. Now, important to realize that gold is abnormally high right now. That for 1,000 years, the gold price was very stable. And that's how South Africa built up its industry from 1887 until really 1972, The gold price barely moved other than went flat and down. And so South Africa learned to innovate, to modernize, to increase their productivity on a regular basis. So the gold price went flat. We had to be very innovative in this country to keep on making money at it. And the rest of the world kind of gave up. South Africa had great deposits. It could put in long-term capital, and it got better and better at producing gold at a lower cost. And that's what kept us in business until 1972. And how good that benefited us is evident that when the gold price did run, all that hard work paid off for shareholders and most of all for the government. So yes, taxes went up hugely with the price of gold. And yes, dividends did too. But as you can see by this graph, government benefits much more than shareholders. They pretty much always have. They pretty much always will. So there's no reason to be demonizing industry when government benefits even more so. And this is just direct taxes and royalties. This isn't payroll tax, land tax, GST, VAT. This is just direct mining tax. You add all those other taxes, the government part would be much larger. And I remind you, this is what the gold price did in real terms. From 1933 until 1973, look at the decrease. But this is like a good Silicon Valley company producing microchips. They get more innovative every day, every year. And this is how you stayed ahead of the curve. You got more innovative and you increased your market share. And that's why South Africa was an industry leader all through the last century. The rest of the world couldn't keep up with it on mining costs. And it benefited everyone because, remember, the gold was flat in dollar terms, 1933 to 1973. And yet, look at this. South Africa doubled the tons mined. This is tons of ore. They more than doubled the ounces produced of gold, the tons produced of gold. You can see from about 400 tons, it even touched 1,000 back in 1970-71. It then came off. With the gold price, we were able to mine lower grade gold. And you want to do that because it extends the life of your mine. So here we were, a country, no rising gold price, flat gold price 40 years, and yet we doubled employment in that time, doubled the number of mines in that time. So that's how good mining was, and that's how efficient we were in South Africa. What's the problem now? Why is gold falling? Why is tonnage falling? Why is our employment falling in gold mining in particular? We can say a lot of reasons. Most of them are man-made / government-made. Nationalization of the mineral reserves in 2002, officially in 2004. Required 25% of your mine must be given away to unknown partners, and most companies are forced into debt to do this. The Labor Relations Act, complex, burdensome, interpretive, and almost always looks like it's stacked against industry. Eskom price increases and stoppages. Eskom you never thought of for about 60, 70 years. It was just always there, and the price was always less than inflation. You'll see later how bad the Eskom price increases have affected mines. From 2 to 10% to 20%, 23% of total costs on mines are Eskom. And it's going up all the time. Union rivalry, populists, politicians, politics, demonizing the mines nonstop in hopes of getting another vote. Inadequate rule of law. We might have a good constitution, but if we can't uphold it, what good is it? The breakup of the mining houses. Now you've got individual mines stranded on their own, low on technical support, low on financial support, social labor plans and requirements. Many of these look like they're more responsible to the government, or should be responsible to the government, yet mines are increasingly being required to do what governments in most countries do. Work stoppages, legal and illegal. New tax and royalty systems. All of these make for less reason to mine in South Africa. Okay, what about the Zambian copper industry? This started in 1900. It built up until 1940. There was a bit fall during World War II. and then it resumed its upward trend until about, you can see here, it was around 1973-74. Now, this was the era of nationalization. Nationalization all over the world of oil companies and mining companies. So you had a change in the mining regime. You could even say a change in government itself. And this is definitely the major reason that you had a fall in production, because by nationalizing everything, foreigners weren't going to put money into it. And so Zambia fell from a height of about 850,000 tons of copper until they were barely doing 200,000 tons of copper in the mid-90s. In fact, I think it bottomed at about the start of the new millennium, from 850,000 tons to 250,000 tons. And it wasn't overnight. It was about a 20-year period, almost 25-year period, 30-year period. Oh, gee, I think I jumped too far here. Excuse me, audience. Maybe I didn't jump too far. Okay, there's Zambia. This is gold mine revenue. Sorry, it's a slide out of order, but it shows how much in real terms today South Africa is making about $6 billion on gold, which is less than it was making in 1942. And that was during World War II. And we had a lot less people than 56 million. And if you look back to 1970, we made about $6 billion. So we're making the same money as 50, 60 years ago, but we've got multiples of the population to satisfy. And if you look at back in 2010, 2012, we should have been exceeding $30 billion like we did back in 1980, but we're not producing the gold. We're producing 150 tons a year instead of 650 tons a year. What does this show? This is the DRC, similar to Zambia. Had a great cobalt and copper industry built up from 1900 onwards. It peaked in about 1972, 450, 500, 550,000 tons. And then we could say, was it the fall of Mobutu? There was definitely a regime change, and production just fell off a cliff. And until we got another regime change about 10 years later, but this is pretty amazing, because you don't just change governments and investment comes in. You have to change governments, change policy, and they have to be very convincing to investors, especially when you've still got investors with fresh in their minds the amount of money they lost recently. But I never could have predicted this. I don't think anybody in the world did. But look at the turnaround that was brought about by foreign investment into the DRC. And this is an amazing story. In less than 10 years, copper produced went from 40,000 tons to 1 million tons. So this is a real Phoenix-type example of what can happen. Now, there was a great metal price increase in here that really did help, too. So you can say, well, they had to be together. A regime change with positive aspects for mining legislation, coupled with a commodity boom like the world's never seen. Another graph illustrating that DRC was able to virtually double its production. Now, if it took it from 1900 to about 1985 to get to 550,000 tons, it's almost inconceivable that it could fall to 50,000 tons and yet go up to double anything it had done before. It's just an amazing story that anybody in mining should look at and want to replicate. And the revenue. Now, it's great. The DRC's getting $4.5 billion off their copper industry, but if you think back, that's what they were getting back in 1970, 1975, and again, with far, far fewer people, not even a third of the people they got now. So even though the revenue has gone up and helps, the people are still a lot poorer now compared to the copper they're earning than they were 40, 50 years ago. And South African copper production. Now you see here, it's fallen since 1980, just like the others, but it has not turned up. So why would our copper production not go up when Zaire's did, Zambia does, and you'll see how Chile's does? And it's more than just price related. It's the environment. It's a legislative environment. The government, economic, labor environment, legislative environment that's holding it down. Now yes, the copper price, it did fall from 1980 until 2002, 2003. But take a look at what Chile did in that time. From 1980 to 2003, Chile increased production from just over 1 million tons a year to 5 million. That's an environment of a falling copper price. This is the same kind of environment South Africa had from 1933 to 1973. A falling metal price, and yet they increased production almost yearly the whole time. And this is what we want to emulate. We want to find out the secret, the formula, the code. What do we need to do to increase production regardless of what the metal price is? Now there's a lot of key technical innovations in copper production, and they all help. But we can see here that really since 1930, the innovations aren't making that big a difference, not in the cost per ton of ore. So it has gotten very, very low. If you go down to 2005, now it's starting to head up. Now technology will help us to keep it down, but we can lower the cost per ton much more rapidly now in this country, not just through technology, but through implementing proper legislation, by making the environment more amenable to mining here. And this is our productivity. Our ounces of gold per employee are the same as they were in 1910, same as they were in 1917. So for 110 years, we're not producing any more gold per person. And without an increase in productivity, our remaining mines will not last another 5 years. We have to find out and implement ways of increasing our productivity. And while Eskom did a sterling job for 60, 70 years, the wheels came off from 2006 on. On my chart, you'll see in the red, that's the Eskom price. And the box at the left shows it. From 2007 to 2015, Eskom's gone up 300%, inflation 45. Now, when your second largest cost goes up 5, 6 times faster than inflation, you just can't stay in business. Even scarier is Eskom looks like it's going to continue to raise prices at least 50% faster than inflation for the next 5 years. So no one is going to sink shafts and put in big money in gold mines or other mines in South Africa under this kind of Damocles sword. Now overall, South Africa has changed the way people on mines get allocated money. We've gone from what was pretty much meritocracy. Everybody got paid according to what they produced and how well they produce it. Now we say South Africa is placing privilege and history over meritocracy. And we've seen that in too many industries here. And unfortunately, it's being forced very much top-down from government. Real quickly, how does our budget speech affect the mining industry or jobs? Well, royalties are so small now. 3 billion rand, and our budget's 1.2 trillion. So mining, from a tax point of view directly, barely even contributes. Treasury is forecasting much more than is likely, but even their forecasts are puny. Less than 1% of Treasury's money comes from mining. So they're not giving it any emphasis. In fact, government seems happy with the Davis Tax Commission that looks more inclined to close mining. Zero mention of stimulating mining or job creation. Hardly any, if any, of the 2004 Mining Petroleum Resource Development Act encourages mining. If If anything, it was a double cross to the industry. There's too much uncertainty, corruption, favoritism in permits. Government is regularly threatening to take away mining rights. The money bill, complex royalty on top of mining tax when you're not even making money. Ever-changing social labor plans, laborious, ever-changing water rights, unconstitutional aspects of the Labor Relations Act. You hardly know where to start here if you want to improve the environment for mining. Ideology still rules South Africa. Government lacks political will to do what needs to be done. Gordon's only one man. We need meritocracy. We need productivity. There's just no other way. Gold mines make money from hauling rock out of the ground. This graph shows you the average ton of rock coming out of our gold mines. Now, it's not as high as it was a couple of years ago, but they're still making $230 for every ton of rock that comes out of the ground. That's a lot better than they're making in the start of the new millennium, 100, and it's a lot better than they were making from 1910 until 1970, when they were averaging barely $100. So our long-term average is 150. We're making 230 today, and yet we're continuing to close gold mines. And this is with the rand appreciating, an average of 6.4%. We're a rand-based economy. Most of our costs are in rands. So this continual depreciation of the rand should be helping our industry. But all it's helping it do is stay alive. It's not helping it grow. It's not enough. And despite all the problems of the 40s, 50s, 60s in South Africa, we still managed an average of 4.5% growth, nearly 5%. And now we're so liberalized, we're friends with the world, there's no sanctions, we can do whatever is best. Now we're battling to do 2% a year, and from 2016 on, it looks like we're going to battle to do 1% a year. And we've got a much higher gold price. There was no gold price in the 40s, 50s, 60s, remember? It was stuck at 35 an ounce. There was no weak rand, no rising gold price. Now we've got a weak rand and a strong dollar price, and we can't make it. Now Chile, it definitely used its depreciating currency to increase production, but it had a generally stable and amenable legislative environment, government environment for mining. It didn't have the rapid population growth we've got. If you look at this country, we peaked at 1,000 tons in 1970. We had maybe 23 million people then. So now we're producing maybe an eighth of the gold we did, and we got 2.5 times the number of people who are placing huge demands on government and on industry. And we know with rising populations comes rising unemployment. Chile's unemployment, I think, averages about 6.5%. Our unemployment, 26.5%. So something's wrong. We got all these minerals. We got high unemployment. Chile's got a lot of minerals, and they got low unemployment. So as we said before, our revenue is down to where it was in 1930. So we had hardly any people living in South Africa in 1930, and they had the same gold revenue as we do now. So there's just so many more people to spend this little bit of revenue on. Now in rand terms, average of 15% per year since 1969, you would think this would be great for any industry if it can rely on an average of 15% a year increase in revenue. But we're unable to capitalize on it because we just have too toxic of an environment to mine in at present. We've got to change our environment, then we can take advantage of this rising gold price in rand terms. Where have we gone since 1980? From the most modern, ambitious mines on the planet. We're now stripping and destroying mines. We're filling in shafts. We're sterilizing tens of millions of ounces in the ground that nobody will ever access again because they're 2-3 kilometers underground. It's just too big a risk, too big a money, too long a time. And our new gold industry is heading towards artisanals that are mining anything shallow. Now they're making good money mining like cavemen, and yet our modern companies can't make it. at today's gold prices. Shaft sinking, we just completely stopped sinking shafts after 110 years, and now we're filling shafts in. You fill shafts in, you're sealing your death warrant. You're sealing your tomb. We've gone from gold mines to shopping centers. Gold mines have fallen from 65 in 1985 to 8. Shopping centers from 350 to 1660. There's now more listed property shares on the market today than we had gold shares in the heyday in the 80s. Casinos. We've gone from 5 to 37 casinos. They now employ 90,000 people instead of 15, but I don't know where they're getting the money to gamble from. It's not coming from the gold mines or their employees. Rule number 2 in life, what's your benchmark? Any investor is going to compare your investment with what he can get in the most stable country in the world, the most stable index in the world, the S&P 500, which has averaged 10 to 10.5% for 100 to 150 years. So no one's going to come to a far-off country and invest in something risky if it's not promising a much higher rate of return than 10% in dollars. We all know who this man is. Follow the lead. Earnings drive share prices. These are the earnings on the S&P 500. This is why the index goes up. Now these are the earnings of our all-share index until the last 4 or 5 years, and they did average, with dividends, 12% a year total rate of return. So it was worth coming here for 100 years because you had a 2% higher real rate of return. Sorry, this is nominal, but still, you had a 2% higher rate. And our gold index, for 100 years, averaged a 14% total rate of return until 1990. So that's why foreigners were investing in gold shares for 100 years. But now, the JSE Resi, earnings are down 94% from their peak a few years ago. They're down to where they were in 1973. Now, that does look like an opportunity. There will be a rebound, but that's the magnitude of the fall-off. The gold index, it's barely got its earnings above zero, but look where it's been falling since the late 70s. Look where it's been falling since the early 80s. It's almost been one-way traffic. So we need reasons to believe this will change before we invest in it. Platinum, totally wiped out. Earnings in negative numbers. So, this is why there's not a long line of mining investors coming to South Africa or to many other countries, certainly in Africa. They're too beat up, out of money. We've been through some of the problems. And legislation needs to look at this, because too much of our legislation was based on the world's largest running, highest gaining commodity boom. Unfortunately, that's when the new Minerals Act was developed and put in place, and those are abnormal conditions. And you can't base legislation for a long-term business like mining on abnormal situations that do not last. You can't make policies on these kind of moves. And that's exactly what's happened here. Too much of government policy is based on once-in-50-year, 100-year mining booms. Mining supports at least another job to 2 jobs in this country. So if our gold mines have gone from 550,000 people to maybe 100, 120, where's the other 400,000? On the street. And then there's 2 engineering type jobs or support jobs for every one that's lost. So we've lost a total of 1.2 million people in the mining and related industries the last 30 years. Underground mines create 10 times the opportunities for employment as an open pit, 1/10 the environmental damage. And most of our deposits are underground, and they require 90% local content that we used to supply. These are all the winning reasons government should be backing mining in this country instead of attacking it. Unions, are they helping? Helping who? And helping do what? How much of our sector's underperformance can we attribute to that? Impossible to say, but they're definitely contributing to it. They're not helping mines stay open. without helping mines become more productive and innovative. More legislation. All we ever hear is more legislation, more legislation. We now have 34 ministers that all have their own interpretation of the Constitution and the Minerals Act. So who's in charge? Virtually everybody except the shareholders. Now you got unions fighting unions. Who's running the industry today? Well, we've had a replacement almost every 2 or 3 years of a mining minister. So, a radical new industry, it's being run by the pirates, the bandits, the artisanals that don't have to follow any rules and regulations. High costs, there's way too many reasons for high costs on our mines. And what really matters to most South Africans is jobs and poverty. So if this is what worries most South Africans, and the mines can supply answers to both of these, why aren't the politicians reading this? Why aren't they assisting the mines to eliminate unemployment and poverty? We definitely need a new blueprint from the past 25 years, because the blueprint we're on is taking us to Armageddon. Now, is Valentino Rossi, motorcycle rider, is he going to bring us a blueprint? Well, what did he do when he went from Honda to Yamaha? And Yamaha just couldn't win a world championship in the Open Class Moto Grand Prix, and when Rossi's there, they did. Was it just a rider? Or is it from Japan? Kaizen. Constant innovation and improvement. You only take one step at a time. You don't throw everything out and try and rebuild everything from scratch. You make one change at a time. If it improves, you make another. If it doesn't improve, you back off and get rid of it. Remove job reservation, remove privilege, and just reinstitute meritocracy. Like the Chinese-American Transcontinental Railroad 63 to 69. There's a little bit of green at the far left. That's how much was done in 2 or 3 years. They were making no headway until they removed job reservation and they implemented meritocracy. And they allowed the hiring of Chinese and blacks and other minorities. And these people developed all the skills that they brought from the gold rush of 49. They were able to take on all the jobs, dominated the master blaster and other high-class jobs, and near the end, on a bet, they laid 16 kilometers of track in 1 day. Can we do the same today in a month? No more job reservation, meritocracy only. And humans are much more flexible than any machine. So if your ore body allows the use of humans, let them work productively with the right machines. Don't try and force giant, complicated, expensive, imported machines in places where they're not productive. Pay people for what they produce. And train people. Instead of just breaking rocks with their head, that they're using their head. These slides show that the pay went up from 21 a day when I was first starting mining, 8 years later, 200 a day, and I'm still breaking rocks, but now I'm using my head. Now I'm doing it productively. Is it really so hard to make tomorrow better than yesterday? Not if you look ahead and you want to. Let's go invent tomorrow rather than worrying about yesterday. Thank you.
Peter, thank you very much. That was an incredibly interesting presentation, and I hope that we're going to be able to take some worthwhile learnings from there. So we have a couple of questions which we can go through. And ladies and gentlemen, if you are listening and you have any questions that you'd like to submit to Peter, please feel free to use the question and answer button on the left-hand side of your screen, where you can present or send through any questions that you have. And the first one that we have is from Pardon, who wants to know what has underpinned the global recovery in mineral prices.
Great question. Because after 5 years of falling metal prices, we were all starting to wonder, will they ever recover? Look, prices definitely ran too hard, too long. And most of us know the reasons for that. It was 20 years of falling metal prices, which equaled 20 years of shrinking production, or 20 years of no reinvestment of money into new production, coupled with China's dramatic growth in becoming the second largest, richest country on the planet, coupled with interest rates falling to zero, coupled with stimulation like the world has never seen. So we had those four factors that drove mineral prices to levels they never should have gone to, and they held them longer than they should have. And what we saw the last 5 years was metal prices reverting to the mean. Almost everything in life reverts to the mean. It's all about gravity. You can't get away from it. So metal prices, they hardly stay at the mean. They're usually going above it or falling below it. And in December, January this year, we saw what you call capitulation. After 5 years of falling metal prices, falling metal shares, people gave up. Investors didn't want to know anything about it. Companies were in big trouble with their debt. Anglo American, Rio Tinto, Billiton, Glencore, you saw. So now they sell any asset they've got to raise money, and that caused capitulation, which means prices now go to ridiculous levels that we all know are unsustainable. And that's what happened in December and January. Gold fell all the way down to about almost 1,000. Platinum was touching $7.99. Oil touched $28. Now, if you look at the long-term price of these metals, they were much higher. The long-term price of oil in real terms is about $48.50. The long-term price of platinum is about $9.50. Copper, long-term price maybe $2.20. So most metals fell below their long-term prices, and there was some shrinking production, cutbacks. What we see today are pretty much average long-term prices. So I don't anticipate much change a year from now or 2 years from now in most of these commodities. The aberrations are gold. Its long-term average price is about $600, $650. So I don't know what it's doing here at almost 13. Coal's long-term price is about 58. I hear it's hitting 85, steam coal. So those are the two outliers on the top. And on the bottom, I think it's only uranium that's trading so low. Uranium's trading at about 22. Its long-term average real price is about 48. But it's probably just all the negative image of uranium and its actual negative traits. You know, how do you get rid of it? It's dangerous. How do you get rid of the waste products that have a 50,000-year half-life? And there's a lot of alternatives for uranium, especially renewables. So even with those, I think uranium will come back up. It might not get back to its mean, but I don't think it'll stay this low. But the rest of the metals are trading pretty close to their mean, and I think they'll stay there. Whatever our economic situation, I think they'll stay around the means.
Thanks very much. Ahmed has a question in that he wants to know, what is the percentage of proven gold reserves being mined today versus peak gold mining?
Well, peak gold mining to me means last year's production, because I think it was about 3,250 tons we produced last year. And I think the year before was close to 3,200 tons, and the year before 3,100. So I believe that was probably peak production. Well, that was peak production in the history of man. We never produced 3,250 tons of gold in a year. But China is continuing to increase its production each year, even though the gold price is only 1,270 from 1,800, 1,900. And so as my graph shows you, a lot of countries are very happy with today's gold price. And most countries can produce gold below 1,000 an ounce. Now, what are the proven reserves? See, South Africa, because we can't economically produce much gold at today's levels, our proven reserves have really shrunk. Now, if you can increase your productivity so that you can produce gold at 600 an ounce, we would probably double or triple our reserves overnight. South Africa has the resources. We've got 50% of the world's known gold resources, but we don't have 50% of the world's reserves, because A reserve, by definition, means you can profitably extract your gold. And we unfortunately can't profitably extract much of our gold at today's gold prices. Either that gold price must go up, or we've got to dramatically increase our productivity, which looks like it's a long shot.
Thanks, Peter. That actually brings me into the next question, and that is, why has the cost per ton started going up? Why is productivity low? Besides, obviously, the increasing electricity costs, what other factors are impacting on the cost per ton?
Okay, lots of factors. Yes, Eskom seems to be one of the most uncontrollable factors of all. So the average gold mine 20 years ago, Eskom was maybe 10-11% of their cost, and now it's 22% of their cost. So there's 11% of your profit margin gone forever. And it's going to be worse if you stay hooked up to Eskom. If you look at the suppliers, they've had double-digit cost increases all through the last 15 years, even though this country's inflation was half that. I think our inflation only averaged about 6%. Now, your suppliers always increase costs when the commodity price goes up, because they're able to. When the commodity price goes up, there's excess demand of mines for more equipment to expand. So the suppliers take advantage of it, and the mining houses, they just pay it. The mining companies just pay it because they want it. Their commodity price is going up 10, 15, 20% a year, so they don't mind paying 10, 15% increase on components, on services. The problem is the gold price can fall tomorrow, but it takes years to get the prices of those components and services down, but they will come down. The hardest part after Eskom, though, is labor. Labor also got double-digit increases almost every year in this new millennium. And that would have been bearable if their productivity would have stayed the same, but it didn't. It fell. It means they're producing less tons of rock per man. They're producing less tons of gold per man, less ounces per man. And that's work practices. That's attitudes. And unions and government have a lot to do with that. If our mines are working 280 days a year, and our competition, that means all the other gold mines in the world are working 360 days a year. So there's 80 days we're sitting on our hands. So naturally, we got the worst productivity because we're working the fewest days. And we don't work triple shifts in this country. Some of the mines work double shifts. Overseas, many, many mines are working triple shifts. So they're working many more days a year, many more shifts. And then you've got to have work practices that are based on meritocracy, that people's pay is dependent on how much they produce. And if you have too stringent of union demands that everybody gets paid the same, regardless of what he produces, that's going to affect your productivity too, hugely.
And if you were to, say, pull out potentially the two biggest changes that Chile made to their, or have implemented in terms of their policies, what do you think the two are that have made the biggest difference?
I'll use the word government because it is mostly government. And you can put together tables that show their tax rate, tables that show their royalty rate. You can get tables that show what their miners are paid compared to ours. And they're making more than ours. But it's government, unions working with the mines. It's employees and communities working with the mining communities. Government in Chile realized how dependent the country was on copper. And especially when the copper price fell for 20 years, government couldn't just sit there and wait for the price to go up. Now, they did really depreciate their currency, and there's no underplaying how much that helped. But we've massively depreciated our currency, and it hasn't stimulated any new mines because we are at war here. It would be bad enough if we just ignored our mines, but we're flat out at war. Our government, the ANC in particular, has demonized these mining companies for 30 years. And that might be cute from a populist point of view. It might help you get a few votes. But it's destroying your industry. And government benefits more by the gold mine industry than anyone else. So they've got to stop this short-term populist rhetoric and the legislation we've got. Does Chile have 25% BEE? Did Chile nationalize mines? Yes, they did, but they realized very quickly how detrimental that was, and they unnationalized it. But we don't have any backing up in any of our negative mining legislation. We've had just 20 years of negative legislation increasing year after year after year with no backup. So it's up to government to change this environment.
We have time for, I think, 2 questions. So if you do have any further questions for Peter, please feel free to send them through. In terms of the current situation in South Africa, what do you think the biggest change would be that the government could make that would have an immediate impact or an almost immediate impact on the viability of our mining sector?
It would probably be somewhere between changing BEE, which is so uneconomic in 90% plus of the cases anyways, because mining's risky. Most mining shares are very volatile. Most of them fall more than they go up. So why are you forcing companies to borrow money and give 25% of your company to a community, and that community now incurs debt, and they sit and they watch the price go down, down, down? It's not soul destroying on its own. It's psychologically destroying. It's capital destroying. I think government has to realize if BE worked, it would be in other countries. And if it's destroying your industry, how can you point to good parts of BE? Government really, they were a 45-50% shareholder in all profits of mining anyways, by virtue of the gold mine tax. The government averaged 45-50% tax on all proceeds for 100 years. So they virtually were owners anyways, and they didn't have to pay anything for it. They didn't have to take any risk. So the BE is a huge impediment, probably even more than the nationalization. That was one-off, and it destroyed the incentive to come and build new mines because you can be threatened that your mining right will be taken away. But BE, it just saddles any investor on day one with a huge debt and with a partner that he doesn't have any money to put in and help build the mine. So, and the Labor Relations Act, I think there's so many aspects of it that are unconstitutional and that are used against the mining companies. The massive social and labor plans that the government should be doing anyway with the tax money. But yeah, probably BE, and then after that, the Labor Relations Act.
So when we were talking earlier, we were speaking about the increase in Chinese investment in South Africa and in Africa generally. What does that increase in investment actually mean for Africa? What does it indicate, first of all? And secondly, what are the long-term implications?
Chinese investment per se, on the surface, is no worse than anybody else's investment. They're bringing money into the country. And we've seen that's how you grow your industries, especially more than your competitors, your other countries. The more investment you get, the more likely you'll grow your industries. So for China to come into Africa, it should be a big positive. But if you bore down and look deeper, you find out that I think the majority of this Chinese investment is replacing another country's investment. In other words, a lot of these Chinese mining investments I've seen are taking over from Western companies that have been in here for 5, 10, 15, 20 years. So it's not really new investment, and you have to ask yourself, why are these Western companies getting out? So if you had a nice dispersion, a nice diversification of investors, Europe, Far East, South America, United States, Australia, and other places. And now, if all those investors, or a large part of them, are selling, and they're all selling to Chinese, you're losing the ideas. You're losing the interaction with ideas and cultures and the modern Western world. And sure, China can bring in new ideas. They're bringing in money. But can you imagine if all these different countries are giving their assets to Chinese? Now you're going to be very, very dependent on one government. And when you get very dependent on one, there's leverage over you that you might not like. And all of a sudden you can't play one country off another. So I think that should be the concern, that if all your current investors are leaving and they're only being replaced by Chinese, and are you sure the Chinese are going to respect human rights, the laws and constitution that you're used to working? Are you sure China is going to respect the environment and the social labor plans that you've got in place? And even if they do, there's no competition on them anymore to try and make it better, to stay ahead of competing countries or companies that want to come in. So I think countries should all analyze, are we getting net Chinese investment, or is this Chinese investment that's just replacing someone else leaving?
Okay. Unfortunately, ladies and gentlemen, that is all we have time for today. I'd like to thank you for your time this afternoon, and Peter, to you in particular, thank you for your time. I hope that you've enjoyed this webinar. I hope that you found it useful. The presentation and audio will be available from tomorrow morning, and so that you can listen to it on demand. And if you have any questions for Peter, you are more than welcome to contact him either via Mining Review Africa or do you have an email address you'd like to share with the audience?
Yes, sure. As long as it doesn't turn into too much spam and then I have to block you. But let's give it a try. You can get me on peter.major at Cadiz, CADIZ.co.za.
So that's in particular if you have any questions that you'd like to address to Peter privately that you didn't feel perhaps this was the right forum to be doing so. Once again, ladies and gentlemen, thank you for your time. I'm Claire Falkbane on behalf of Mining Review Africa. Thank you very much.